to commodities, and in his recent statement, Federal Reserve Chief Ben Bernanke says that surging food and energy prices won't accelerate inflation in the United States. To look closer at this and the commodity sector in general, I spoke with Jonathan Barrett from Commodity Broking Services. Jonathan Barrett, welcome to Business Today.
Good morning, Whitney.
So what do you make of Ben Bernanke's statement that, climbing food and energy prices won't boost inflation?
It's quite interesting, particularly when you're seeing that some commodities continue to go through the roof. I think Americans just probably won't be able to afford some commodities the way it's trading. So I think it is quite interesting. But one thing, it is a bit too early to tell, but what we are seeing is there's a cost-push type of inflation developing in America and a demand pull in Asia. So the key to global mix will be exactly what policies they implement to make sure we have global growth. So it's a good space to keep an eye on.
It's interesting, though, because it feels counterintuitive, the statement from the Federal Reserve Chief, that this will not raise inflation. Is he just trying to calm people down over there?
I think he's just trying to command. Remember, they've spent $600 billion on stimulus. So naturally he's going to get some flack from the emerging economies. There's no doubt about it. But when you look at spending that amount of money, you'd expect to see some signs of life. We're just starting to see a turnaround in employment in the States, and that's a positive thing. But the record we've seen over the last 6 months has been relatively poor in terms of employment. As such, we haven't seen that growth in the economy, which has caused prices to go higher. So I think he's just levelling people down and just making them feel a little bit more comfortable so they will actually put their hands in their pockets and start spending.
Yeah, just on that point, I mean, I know, unemployment figures are not necessarily your expertise, but I'd like to get your input on that. Do you think that the US employment sector is really recovering? We've seen a raft of data out, the non-farm payrolls and then, other further economic data that has indicated that it is recovering. But do you think that's just maybe just a little tick up and it would flatten out again?
That's a hard thing because you're seeing so much priming occurring and we've only just started to see a lift. The actual employment for last Friday, we were expecting over 100,000. We only got 35,000. So it really hasn't ratcheted on and you've got to be a little bit concerned that we're throwing so much money in it and we're not employing people. So does that mean we're just going to have an uptick now and then it'll level off when the Fed starts to not stimulate? And I think that's one of the keys that we're keeping an eye on to how commodity prices will actually trade.
Yeah, it's not necessarily indicating strong growth there in the United States. If we look elsewhere, oil has fallen to its lowest level in a week. Now, that's off the back of easing tensions in Egypt. What are your thoughts on that?
Well, we always build in this Middle Eastern premium.
I mean, supply was never stopped. The Suez Canal was always open. So
it's just a premium which is actually built in. The whole region, when you look at anything that happens in Iran, the Straits of Hormuz, when you look at anything that happens close to the Suez, there's this contagion feeling that the market actually feels. So they're actually building this premium, and that premium could anywhere between 5 to 10%. Now, as tensions start to ease, and we get a raft of data from the States in particular that says, hey, the economy's not doing what it should be doing, and we're getting a build there, then that leads to that commodity actually adjusting its price and its value. And that's what we're seeing. Crude oil, 92.50, 88, 86 on the downside, a breakthrough, 85 on the downside from there on. So it's still in a big range. And futures have fallen 5.1%, I believe. What does that mean then? It's just lower prices? It should mean lower prices back to the pump. That's what we hope. So we'll just really have to see. So what's your assessment then? When you say lower prices, where do you see it heading? I actually see it sort of trading down to 85 US dollars. 80 is the lower end of the range, and in my mind that would represent where you'd want to buy. That also represent where we feel, if it gets down there within a month or two, then that's the area where we feel economies can actually clear the commodity profitably, and then that would represent where demand should pick up. Okay, Jonathan Barrett, now let's move on to another issue. Since we last spoke, Cyclone Yasi was sort of in the background, but now it has well and truly hit, and we're seeing the devastation, the
aftermath. It's really damaged the sugar industry, which was suffering from the floods before that. So what does this mean then for the rest of Australia's sugar industry that is left?
Well, what it means is that the northern Queensland equated to about 33% roughly of sugar production. So what we're seeing, that's going to be totally wiped out. And when you think that Australia exports 76% of its sugar, it will have an impact on the global supply of sugar. And it comes at a really bad time when sugar already is at over a 30-year high. So this is a compounding issue that I think has to be watched very, very closely.
So how much higher can it go then?
Look, I think a lot of us are starting to feel if the La Nina effects start to work their way around a lot of the sugar producers, which historically it does happen, then sugar in itself can quite easily put on another 10 to 15%. So we can see prices quite happily of 35, 36. So it is an effect. Once again, there's also that compounding inflation thing which we're arguing about at the moment.
Well, it's quite a concerning issue. Jonathan Barrett, we'll have to leave it there, but thanks for joining us in the studio.
Thanks, Wendy.